I think for me, my big question is, why didn't you lock in low rates for a longer period of time when rates were at zero just, what, a year or two ago?
So the interesting thing is that Royal Caribbean did come and tap the markets when rates were lower. The issue is that they have $23 billion of debt outstanding, so there's a lot to manage. So it's unfortunate that they waited this long, but they've had to sort of stagger how they're going to offer these refinancings in order to make sure they have enough demand for the debt.
Okay, well, I think that's what we're all sort of focused on now. I think if they had come to market a year ago, we probably wouldn't have had you on. But of course, all the focus on that Citrix loan deal, and of course, Tellurian actually saying that we're actually not going to come to our market with that junk bond deal and instead try to find some other way of financing. Yeah. What's the likelihood that there will be enough demand for that Royal Caribbean restructuring?
I do think, I don't have a crystal ball, but I do think that there will be demand. I think the big question is that where is it going to price and how wide is the yield going to go during pricing discussions. When you look at Citrix, that bond priced at 83 cents on the dollar. That's one of the steepest discounts of the entire year, and it's really setting the tone for the rest of the market, especially on the LBO side.
And how quickly did that deteriorate? Because it was a couple of weeks ago, I was getting notes from people on at big banks or big investors saying, look, this market is still good. Look, we've got a leverage loan, leverage bonds coming into the market. We've got, and then look, the fact that they had to take such a discount.
Yeah, I mean, the important thing to remember with Citrix is that this was underwritten way before any of the volatility in the market started, like way earlier this year, before Russia and Ukraine, before the Fed started really aggressively hiking and showing that they were going to be pretty hawkish. And then also there was that summer rally, which was really interesting. I think that there was a big sell-off, and that was causing some investors to go in and sort of buy the dip. And now we're at this realization that rates are going to go higher, the Fed is not going to pivot, and it's going to be more expensive to refinance and take out money from the bond markets going forward.
How much FOMO, though, is there still left in this market? I'm looking at a terminal chart that we pull up. High yield spreads over treasuries are under 500. You're only at a 482 investment grade. You're only at a 141. We're nowhere near 2020, let alone 2008 levels. Does that show that the minute yields creep up, you do have buyers coming in and saying, that's a decent yield and I'll take it?
Yes, I do think investors are looking to pick up credits that are being sold at a significant discount. They can make a lot of money off of that than in the secondary market. Should it trade up in the long run? So that's like a really important thing to keep in mind.
I'm just going back. I was looking. I couldn't find the company, but it was Centene. That was the record low junk bond yield that we saw for a high yield note, 2.45%. That was in June of 2021, so just barely a year ago. Yeah. And now some of the same companies with similar ratings are basically facing down 8, 9, maybe even more than 10%.
Yes, Citrix, the high yield, the yield came in at 10%. So.